In 2025, one number dominated global economics: China's staggering $1 trillion trade surplus. This figure wasn't just a headline, it became a symbol of the country's immense manufacturing power and its deep integration into the world economy. The sheer scale of this surplus dwarfed entire national economies, outpacing the GDPs of many countries and sending shockwaves through global markets. To many, it seemed to signal unstoppable strength and a new era of Chinese dominance in trade. But beneath the surface, the story was far more complicated than the numbers suggested. Economists and analysts began to question what was really driving these figures. While China's factories continued to ship goods to every corner of the globe, entire cities of empty apartments revealed a deepening property crisis at home, hinting at economic imbalances that numbers alone couldn't explain. The surplus, as impressive as it appears, may be less a sign of economic health and more a symptom of underlying imbalance, one that could have far-reaching consequences. Is China's economic miracle as secure as it appears, or is it masking vulnerabilities that could one day shake the world's financial foundations? Tonight, we look beyond the headlines and the impressive numbers to understand the paradox at the heart of China's rise, a story of both triumph and tension. On one side, we see a nation building the world's solar panels, electric vehicles, and smartphones, innovating and exporting at an unprecedented scale. On the other, a country grappling with an aging population, falling birth rates, and shaken consumer confidence. The contrast between global success and domestic uncertainty is stark and growing. To truly understand this complex reality, we must first explore how the trillion-dollar surplus came to be and what it means for China and the world. Let's begin. China's path to a trillion-dollar surplus began decades ago, in a time when its cities were just beginning to buzz with the energy of reform and opening up. The seeds of transformation were sown in the late 1970s and early 1980s, as China shifted from a closed, centrally planned economy to one that embraced the world. In the 1980s and 90s, China opened its doors to foreign investment and technology, quickly becoming the global factory for everything from toys and textiles to electronics and household goods. Millions of workers flocked to new industrial zones, powering an unprecedented manufacturing boom. Western companies, eager to cut costs and boost profits, flocked to China for its low wages, vast labor pool, and disciplined workforce. Partnerships and joint ventures flourished, bringing in capital and know-how. The Made in China label soon became a fixture in homes around the world, symbolizing affordable products and fueling years of rapid economic growth. China's exports soared, and its factories became the backbone of global supply. The real turning point came in 2001, when China joined the World Trade Organization. This move unlocked access to global markets, supercharging exports and integrating China deeply into the world economy. China became essential to global supply chains, not only lifting hundreds of millions out of poverty at home, but also lowering prices for consumers worldwide. Its ports bustled with activity, shipping goods to every continent. But China didn't stop at producing low-cost goods. As wages rose and competition intensified, the country began to climb the value chain, investing in technology and automation. Policymakers launched the ambitious Made in China 2025 initiative, aiming to dominate high-tech industries like robotics, aerospace, and advanced manufacturing. The goal was clear: move from quantity to quality. The focus shifted to cutting-edge fields: robotics, artificial intelligence, and green energy. Massive investments poured into research and development, fueling innovation and technological breakthroughs. By 2025, China had become a global leader in exporting electric vehicles, solar panels, and advanced batteries, setting new standards for the world's green economy and high-tech industries. The surplus was now built on sophisticated high-value products, not just cheap consumer goods. China's exports reflected its technological ambitions and growing expertise. China was no longer just a low-cost producer. It had transformed into a formidable high-tech competitor, challenging established powers in innovation and efficiency. This remarkable transformation is the key to understanding the sheer scale of China's modern trade surplus, which has reshaped global commerce and shifted the balance of economic power. The journey from cheap goods to cutting-edge exports didn't just change China, it fundamentally reshaped the global economy, influencing everything from supply chains to consumer choices. But this extraordinary success came with new challenges: environmental costs, labor unrest, and debates about the future direction of China's economic miracle. For years, the US was China's top export market, but after 2018, tariffs and trade tensions forced China to adapt. Chinese exporters pivoted, targeting Southeast Asia's booming middle class and integrating neighbors like Vietnam and Malaysia into their supply chains. Europe became another focus, especially for green tech. Chinese electric vehicles and solar panels flooded European markets, accelerating the continent's energy transition. Despite friction with local industries, consumers embraced affordable, high-tech Chinese products. China's diversification paid off. As US exports slowed, growth in Asia and Europe more than compensated. The global trade map was redrawn. China's export machine was no longer dependent on a single customer. It had built a global network, a modern Silk Road for the 21st century. This adaptability fueled the ever-growing surplus. China's export dominance is no accident. It's the result of a powerful combination: state policy, technological innovation, and relentless corporate ambition, all working in tandem. Over the past few decades, China has transformed itself from a manufacturing hub for basic goods into a global powerhouse for advanced technology and high-value products. The government identified and targeted strategic sectors, pouring vast resources into green technology, electronics, and high-value manufacturing. This wasn't just about building factories, it was about building the future with a clear focus on sustainability and technological leadership. Generous subsidies, tax breaks, and direct support allowed Chinese firms to scale up at an unprecedented pace. This rapid expansion drove down production costs, making Chinese products more competitive and enabling them to outpace global rivals in both quality and price. In sectors like solar panels and electric vehicles, China's state-backed giants didn't just compete, they achieved global dominance, setting benchmarks for efficiency and output that others now strive to match. Technology was the other crucial pillar supporting this rise. China shifted from being an imitator to becoming a true innovator, now leading the world in patents filed and investment in research and development. This focus on innovation has fueled breakthroughs across multiple industries. Companies like Huawei and BYD have emerged as global leaders, setting international standards in smartphones, electric vehicles, and next-generation technologies. The synergy between forward-thinking policy, massive investment, and a culture of innovation has created a formidable export sector that continues to grow. China's unique ability to deliver advanced technology at lower prices is a key driver of its massive trade surplus, making its products indispensable worldwide. The model is clear: the government sets the direction, provides support, and companies execute with ambition, conquering markets across the globe. This powerful formula has not only fueled China's rise, but has fundamentally changed the global economic landscape, reshaping how the world trades, innovates, and competes. While exports soared, China's real estate sector quietly unraveled. For decades, property was the main engine of wealth for families and a key source of local government revenue. But the boom was built on debt. Developers borrowed heavily, fueling endless construction. In 2020, new rules cut off easy credit, and giants like Evergrande teetered on collapse. Millions of buyers were left in limbo, waiting for unfinished homes. Home prices fell, shattering confidence and chilling the broader economy. The crisis exposed a deeper flaw: overinvestment in property, underinvestment in social safety nets. Empty apartments became symbols of imbalance. Now the government faces the daunting task of cleaning up the mess without triggering a financial meltdown. The stakes couldn't be higher. Beyond real estate, China faces a demographic time bomb. The one-child policy created a shrinking, aging population. In 2022, China's population fell for the first time in decades. Birth rates remain at record lows, despite new incentives. The result: fewer workers, more retirees, and rising pressure on social services. Labor shortages threaten China's manufacturing edge. An aging society means higher costs and weaker consumption. There's no quick fix. Demographics will shape China's future for decades. The challenge is profound and inescapable. China's economy is out of balance, strong on production, weak on consumption. Domestic spending lags far behind other major economies. Households save heavily, wary of medical bills, education costs, and uncertain retirements. The property crisis wiped out wealth, further eroding confidence. Youth unemployment is high, making families even more cautious. The result? A vicious cycle of weak spending and slow growth. The government has tried subsidies and incentives, but these are only temporary fixes. Real change would require a stronger social safety net and a shift of wealth to households. Until then, China remains dependent on exports, vulnerable to global shocks. The consumption conundrum is a major obstacle to sustainable growth. Solving it is China's next great economic test. China's economy is deeply woven into the global fabric. A slowdown in China would send shockwaves worldwide, disrupting supply chains, slashing demand for commodities, and rattling financial markets. The COVID-19 pandemic offered a glimpse. Factory shutdowns in China led to global shortages. A deeper slump would be far more disruptive, hitting everything from raw materials to multinational profits. Commodity prices would plunge, hurting exporters from Australia to Brazil. Financial instability in China could spook investors everywhere. China's health is now a global concern. The world can't afford for China to stumble. In 2026, China's trillion-dollar surplus projects strength, but deep vulnerabilities remain. The real estate crisis, demographic decline, and weak consumption are structural cracks in the economic miracle. China's leaders must defuse the property bubble, boost domestic spending, and navigate a complex global environment all at once. The risks are enormous. A misstep could trigger a crisis with global repercussions. Yet, China has a history of overcoming challenges through state-driven action and long-term planning. Its resources, political control, and strategic vision are formidable. The future isn't set. China could rebalance and build a more sustainable model, or its contradictions could bring it down. The coming years will test China's resilience like never before. The world is watching to see if the dragon can keep flying, or if it will finally be grounded.